Hello. Today we're going to talk about inventory. Up until now, we've been looking at a service-based business simply because a service-based business is easier to account for. Now we're going to look at a retail or a merchandise-based business, and we're going to introduce inventory. Okay, and so we have several new accounts and some new financial statement terms that we're going to introduce this chapter. First, we have merchandise inventory. I don't know if you can see my little infrared dot there, probably not. This is a current asset. Inventory is purchased from either the manufacturer or a wholesaler, and all we do is we mark it up and we sell it. Walmart, Target, Kmart, all these stores. So much going on out there that's retail. All they do is buy the goods from some other company, raise the price, and sell it. So merchandise inventory is meant to turn over. That's the term we use with inventory. Inventory turns over. The faster, the better. So it is a current asset since it should not be sitting around all that long. Then we have a new revenue account called sales. Okay? We saw service revenue previously. Now we have sales revenue. Okay, but we simply call it sales. But when you hear sales, you say to yourself, that's sales revenue. Cost of goods sold. Okay, this is the cost of the merchandise that we bought from whatever company. Okay, and so if I bought a textbook for $50 and I sold it for $70, my sales revenue is $70. My cost of goods in this case being the books, the cost of the book sold was $50. Okay, and I made a $20 profit. Okay, so cost of goods sold is an expense. Okay, now I'm looking over to the slide here, but it's showing up on your monitor there. But anyway, this is where I see it. So cost of goods sold is an expense account, and we're going to subtract cost of goods sold from sales to determine a term called gross profit, which we mentioned down at the bottom here. We also have a couple of revenue-related accounts called contra accounts. Now we've seen contra accounts related to property, plant, and equipment. We have the accumulated depreciation account, which we use to reduce the value of the asset each year after we record depreciation. Similar concept here. When we sell product to our customers, sometimes we will offer them a discount to pay us back earlier, and if they take a sales discount, that reduces the amount of revenue we have. In the event our customers return items, we have a sales, returns, and allowance account, and that'll reduce our original sales to what we call our net sales. So both sales discounts and sales, returns, and allowances are contra revenue accounts. Now remember, revenue has a normal credit balance. Okay? And being a temporary account, we close it out at the end of each period. Sales, returns, and allowances and sales discounts are contra meaning opposite, so they have a normal debit balance. And we're going to take our total sales minus the sales discounts for the period, minus the sales, returns, and allowances, and that's going to give us something called net sales. And we'll return to that a little bit later today. Okay, so we have these new accounts: merchandise inventory, sales, cost of goods sold, sales discounts, sales, returns, and allowances. On the income statement, we're going to restructure our income statement, and we introduce a few new terms. We just talked about net sales. Okay, sales minus discounts minus returns equals net sales. Net sales minus cost of goods sold gives us gross profit. And then when we subtract from gross profit what we call our operating expenses, our selling expenses and administrative expenses, that'll give us something called operating income. We're going to see this a little bit later in today's lecture. Okay? So I just wanted to introduce these terms right now, and we'll revisit several of them a little further on in the lecture. Okay, the first thing I want to also introduce is the concept of shipping costs. Okay, now shipping sounds relatively like no big deal, but it really is, it's a bigger deal in accounting than we first acknowledge. We have a couple of accounts we have to introduce: freight in and freight out. And if you just read the definition, freight in is when we pay shipping costs to get the inventory that we ordered from our vendor or our supplier, same thing, vendor and supplier, same thing, to our place of business, our store, our warehouse, whatever. To get the goods from the vendor to us, we call freight in. We include freight in the cost of our inventory. It causes our inventory to cost more. If we pay for shipping costs to get the inventory from our place of business to our customer, then we call that freight out. Normally, the person or the side buying inventory pays for shipping. Not always, but usually. So normally the customer will pay for shipping, but if we pay for shipping, we would call that freight out, and freight out is considered to be a selling-related expense. It's not part of the cost of inventory. It's a marketing inducement to get our customers to buy goods. In a competitive environment, sometimes the seller has to pay shipping costs. Normally, the buyer pays shipping. Additionally, we have two concepts here, what we call shipping terms. We have FOB shipping point. FOB means free on board. We'll talk more about this momentarily. And FOB destination. Okay? FOB shipping point. The buyer pays shipping costs. And title. And title means who owns the inventory. Title of the inventory transfers from seller to buyer as soon as the inventory leaves the seller's business. Okay? We have another slide which has a diagram I'm going to show you. I'm going to work from that more closely. But I just want to define these concepts right now. FOB destination is when the seller pays shipping costs, and title transfers when the goods or the inventory arrives at the buyer's business. Okay? And so we're going to analyze these terms a little bit more closely. Let's take a look at this slide right here. Okay? Now, we have two transactions. We have a purchase transaction and a sales transaction. We are in the middle. Look at the slide. On the left, we see our vendor or supplier. We buy inventory from them. Then we sell the inventory to the customer. So we're the middleman. Okay? We buy inventory from the vendor. We sell inventory to the customer. Remember, in accounting, we focus on our business and our transaction. So even though the vendor is selling us inventory, we call it a purchase, since we're purchasing it from them. And even though the customer is purchasing inventory from us, we're selling it to them, so we call it a sale. So we have two transactions. We have the purchase transaction from vendor to us, and we have the sales transaction from us to our customer. Now remember, normally the buyer pays shipping costs. In transaction one, the purchase, we are the buyer, so we normally pay shipping, and we include the cost of shipping in the cost of inventory. Notice it says freight in, we include as part of inventory, in the cost of inventory. Transaction two, the sales transaction, the customer is the buyer, and normally they pay for shipping costs. If we pay for shipping, you've probably seen commercials on TV that if you buy in the next 10 minutes, we'll include free shipping, some late night commercial. Okay? It's a marketing tactic to try to sell their product. So if the seller pays shipping, we call it freight out. In transaction two, we're the seller. If we have to pay for shipping, we're going to account for freight out as a selling expense, which means it goes straight to the income statement. It does not go on the balance sheet, whereas freight in does go on the balance sheet as part of inventory. Inventory is an asset on the balance sheet. Okay? Whoever pays for shipping costs has to account for the shipping costs. So transaction one, if we pay for shipping, we call it freight in. We include it in inventory. If the vendor pays for shipping, we don't have to worry about it. But normally we pay for shipping since we're the buyer. Transaction two, the customer normally pays for shipping, so they would account for it. But if we have to pay shipping costs to the seller, we call it freight out, and it becomes a selling or an operating expense. Okay? And we'll see this in just a little while. Okay, so now, the issues related to this are what happens on December 31st if the goods, if the inventory is in between seller and buyer. Now let's just assume we are a car dealership for Toyota or Honda, and we're buying cars, and they're coming from Japan, from Tokyo, and they're coming across the Pacific Ocean on a great big boat. Now, it takes usually anywhere from, I'm going to say, 1 to 2 weeks for that boat to leave Tokyo and to arrive in Los Angeles. If the boat is in transit, it's in between point A and B on December 31st, which is the end of our fiscal year in our example, then the question becomes, who owns the inventory that's on the boat? And what year, 2010 or the previous year in December, or the following year in January, which time period should the seller record revenue? These are the two issues. So in order to answer these questions, we have to look at the two transactions separately, the purchase transaction and the sales transaction, and we have to find out what are the shipping terms for each transaction. Now, do not assume that freight in means FOB shipping point and freight out means FOB destination. We have to look at them independently. We only account for freight costs if we pay for them. If we buy the goods from the vendor, we call it freight in. If we have to pay for shipping to the customer, we call it freight out. The shipping terms, let's take a look at each transaction, and you're going to have to kind of follow along with me. This is a little confusing at first. Transaction 1, the purchase transaction. If the terms, shipping terms, are FOB shipping point, let's go back to the previous slide. FOB shipping point, the buyer pays shipping, that's us. We're buying it from the vendor. And title, ownership of inventory, transfers to us from the seller to the buyer as soon as the boat pulled out of the port in Tokyo. So if it's floating somewhere near Hawaii on December 31st, we own that inventory. Whoever owns the inventory puts that inventory on their balance sheet on December 31st, even though we don't have it yet. It's still our inventory. Let me go back to the other slide. Okay. Also, if title transferred as soon as the goods left the port in December, because remember, if the boat is in the middle of the ocean on December 31st, then it left Tokyo sometime in December, and it will arrive at our place sometime in January. 2 different years. Remember, accrual accounting says revenue recognition, we have to record revenue in the proper time period. December of 2010, or whatever year it may be, or January the following year. Okay, so transaction 1, purchase transaction, FOB shipping point, buyer, that's us, pays shipping costs, so we call it freight in. And since the boat's in transit December 31st, FOB shipping point says as soon as they left the docks in Tokyo, the buyer, that's us, owns the goods. We own it on December 31st. We would include it on our balance sheet as current assets, and the seller would record the sale in December. Now, the sale doesn't really affect us. That's the vendor. If the first transaction, the purchase transaction, the terms were FOB destination, then the vendor, the seller, would pay shipping costs, and they would account for it. We don't have to worry about anything. And we would not own the inventory until it arrived, which means on December 31st, Honda or Toyota still owns the inventory. We don't. It goes on their balance sheet, and they would not record the sale until it arrived, which would be January, new time period. Transaction 2. If the terms are FOB destination, FOB shipping point. Now, transaction 2, we call the sales transaction. We are selling to the customer. FOB shipping point, we said buyer pays shipping. Buyer's the customer, right? So they account for the shipping, which is normally the case. And as soon as the goods were shipped, now we're shipping our goods from Los Angeles to New York on a train. So somewhere in December 31st, they're in Nebraska or wherever. They're in transit. FOB shipping point, transaction 2, the customer, who's the buyer, they own the inventory on the train at year end, it would go on their balance sheet. And we, now this matters, we would record the sale in December of the previous period. Transaction 2, sales transaction, if the terms are FOB destination, then the seller pays shipping costs, that's us, right? We would call it freight out, selling expense, and we would own the inventory for the entire train ride to New York, which means December 31st, they're in Nebraska, we still own that inventory. It goes on our balance sheet, and we don't record the sale until it arrives in New York sometime in January the following time period. Okay? So the two big issues with shipping terms are who owns it at year end, December 31st, if the goods are in transit, and therefore who puts it on their balance sheet, and also what time period do we recognize the sale, recognize revenue. The revenue recognition rule, record the revenue in the time period it's earned. We record revenue when title transfers. So go to the next slide here. Freight in, we said, is included in the cost of inventory, becomes part of cost of goods sold on the income statement when we sell the inventory. The shipping terms determine when that sale should be recorded. FOB shipping point, inventory in transit at year end is owned by the buyer. It goes on the buyer's balance sheet. Seller records the sale of inventory in December. Transaction 1, that's those guys. It doesn't matter to us. Transaction 2, we're the seller. Then it becomes an issue. FOB destination, inventory in transit at year end, is owned by the seller. Okay? Now, in transaction 2, we're the seller. So if it's FOB destination, we pick up the shipping costs, call it freight out, right? And we own it while it's in transit. So we put it on our balance sheet, and we don't record the sale until the following time period. So shipping costs actually can get confusing. We have freight in and freight out. Where do we put that cost? Freight in, we put it on the balance sheet as part of inventory, included in the cost of inventory. Freight out goes as a selling expense right to the income statement under the operating expense section. And then we have the shipping terms, FOB shipping point, FOB destination. Okay? So you need to look this over, take your time on it. It is confusing. Is FOB shipping point destination determine who puts the inventory that's on the boat or the train on their balance sheet, and when is the sale recorded? Previous year in December or following year in January? Okay, so you can look at that on your own. Let's see what direction these are going. Let's go this way. Okay, so the next thing we're going to talk about is the journal entries related to buying and selling inventory. Now, there are two different ways in which we can account for inventory. The two methods are called the perpetual inventory system and the periodic inventory system. Okay? We're going to focus on the perpetual inventory system. As the word perpetual tells us, we update inventory perpetually, continuously, after each purchase and each sales transaction. Whereas a periodic inventory system, we only update the inventory account at the end of a time period. Might be the end of the quarter, end of the year. Okay, so we physically count inventory, and that's how we determine the value of inventory. And we keep track of the purchases separately in a periodic system. We're not going to look at the journal entries in a periodic inventory system. We're only going to look at the perpetual inventory transactions. And in this area, there are a lot of journal entries, which is why inventory is a tricky area. However, although I want you to understand the mechanics of what's going on with the journal entries, the only journal entries that I really would like you to focus on would be the purchase of inventory, and when we buy inventory, we debit the merchandise inventory account, since it's an asset with a normal debit balance, and we credit either cash or accounts payable. If we paid cash, we credit cash. If we purchase inventory on account, the terms on account tell us credit is involved. And that tells us that our vendor is allowing us 30 or 60 days to pay our bill. So we credit accounts payable instead. Okay? Now, there are additional journal entries relating to purchases. Just like we have a sales discount, we have a purchase discount. If our vendor offers us a discount to pay early, we may take advantage of it, and that'll reduce the cost of inventory, which is good for us. And just like our customers might return goods to us, we might return goods to our vendor. They're damaged, they're the wrong size, they don't work properly, the wrong color, any number of reasons why goods get returned. If we return goods, it's a purchase discount. Okay? So don't worry about those journal entries related to discounts and returns and allowances, okay? But understand what they represent. Okay, now, when we sell inventory to our customer, there are two journal entries in a perpetual inventory system, and you need to know these. The first journal entry is the actual sale at the retail price, what we charge our customer. If they pay us cash, we debit cash, and then we credit the sales revenue account. If we sell it to our customers on account, that means we're giving credit to our customers. They're going to pay us down the road. Then we debit accounts receivable instead of cash, debit AR, accounts receivable, and credit sales revenue. That's the first journal entry. The second journal entry that we have to record in a perpetual inventory system is the cost of the sale. Remember we talked about cost of goods sold. That's an expense account. In addition to recording the sale at retail price, we have to record the cost of the sale at what the inventory cost us. We would debit cost of goods sold because it's an expense account, and expenses have a normal debit balance. And then we have to reduce inventory. We credit the inventory account because we no longer have that inventory. And since we recorded inventory on the balance sheet at our cost, when we sell it, we credit inventory at our cost. So using my previous example, I bought a textbook for $50 and I sold it to my customer for $70. Okay, if I sold it for cash, I would debit cash 70, credit sales 70. If I sold it to my customer on account, I would debit accounts receivable for 70, credit sales for 70. Then I would record the cost of the sale. Debit cost of goods sold for $50, credit the inventory account for $50. And my gross profit, which is sales minus cost of goods sold, 70 minus 50, my gross profit on the income statement would be $20. Okay. Let's take a look at this example here. All right, sales and purchase discounts are offered to encourage early payment. Okay, so we're not putting it on sale. This is usually between two businesses, business to business. We're trying to get them to pay early. So we're offering them an incentive to say, look, if you pay us a little bit early, you can save some money. Let's assume that the inventory of $1,000 is purchased or sold with discount, and the terms, and this is how we describe them, 210 net 30. Let's define each of these four components. 210 net 30. The 2 is the percent of the cash discount that you will save by paying within 10 days. So you normally have 30 days to pay in our example, but if you pay them within 10 days, they'll let you take 2% off of the normal price. If you don't pay it by the 10th day, then you still have to pay it within 30 days, but there's no discount. So N stands for no discount, and 30 means you still have to pay it within 30 days. So it doesn't have to be 210 net 30. It could be 110 net 45, 310 net 60, whatever. In our example, 210 net 30. You can take a 2% discount off the price if you pay within 10 days. Otherwise, no discount, and you still have to pay within 30 days. Okay, so if we purchased or sold inventory for $1,000, if the payment is made within 10 days, they take 2% off of $1,000, so that's a $20 savings, and instead of paying $1,000, they would pay $980. Okay, so they'd save 20 bucks, not bad. Okay, however, if they don't pay within 10 days, they have to pay the full $1,000. Okay? Inventory. Originally, when we bought it on account, we debited inventory, credited accounts payable. If we take the discount, okay, I'm going to reduce the inventory account by 20 bucks. Since I debited it for 1,000, but it's really costing me $9.80. So I'm going to reduce it by 20 bucks. Okay? And save $20. I don't owe them that $20, so when I go to record my journal entry, I'm simply going to debit accounts payable for the full $1,000. Debit accounts payable for 1,000. I'm going to credit cash for $9.80 since that's what I paid the vendor, and I'm going to credit inventory for $20. Now again, I don't want you focusing on the discount journal entries and the returns and allowance journal entries, but I simply want to describe the mechanics to you so you understand what's going on. We saved 20 bucks is the bottom line. If this were to my customer, then when I sell it to them, I record a receivable for 1,000, credit sales for 1,000. If they pay me within 10 days, I'm going to receive a check for $9.80, so I would debit cash for $9.80. I'm going to debit that contra revenue account, sales discounts for 20 bucks, and I'm going to credit accounts receivable for the full $1,000 since we're even. Even though they paid me $9.80, I'm going to credit for 1,000 since we're even. They don't owe me any money. Okay, so try to picture the mathematics involved here. Sales of 1,000 minus a $20 sales discount would give me net sales of $9.80. Okay, I'm back. Example with a return of inventory, and then they take the discount. Assume that inventory of $1,000 is purchased or sold with discount terms 210 net 30, and $200 of inventory is returned before the payment is made. Okay? So first, $1,000. If $200 of inventory is returned, we subtract that 200. So 1,000 minus 200 gives us 800. It's from the $800. I'll put it on the board here. So $1,000 minus the $200. This is my return. So $800 is owed. If I take the discount, I multiply 800 times 2%, and that'll be a $16 discount. The payment would be $784. Okay? So if they pay within 10 days, it's $784. If we buy it, we pay the vendor $784. If it's our customer, they pay us $784. Again, don't worry about the journal entries, but understand how the mechanics work. If this were a sale, sales would be 1,000 minus sales returns and allowance of 200, contra revenue account, debit balance, minus the sales discount, also a contra revenue account, debit balance. My net sales would be 784. Okay? Inventory, if this were a purchase from the vendor, I debited inventory for 1,000. When I returned $200, I credited inventory for 200, so I have an 800 balance in inventory. And if I pay my vendor within 10 days, I'm saving $16, so I'm going to credit inventory again, since the real cost of my inventory was $784. Okay? And your book explains this in detail. Okay, but it's important that you understand mathematically what's going on here. Okay. Now we're going to look at the multi-step income statement. In the first part, the first few chapters, when we prepared an income statement, we used what was called a single-step income statement. And a single step simply means all revenues were put on top. So if I had service revenue, rent revenue, interest revenue, dividend revenue, whatever source of revenue I had, I put in the top section, and then I added those up, and I had total revenues. Underneath total revenue, I listed all my various expenses. Rent expense, wage expense, insurance expense, utility expense, total expenses, total revenue, minus total expense gives me net income, ignoring taxes. we're going to rearrange the multi-step income statement into a different format because this format is actually a much more popular format used by the majority of businesses out there. Some companies use the single step, most use the multi-step. And notice it says this format is used by most companies. It shows various parts of a company's income and helps to analyze their financial performance. Now, in the very first slide we said, well, wait a second, there's gross profit and there's operating income. These are two new terms. The multi-step format helps us to identify these numbers and helps us to analyze our business. This is simply an example of a multi-step income statement, and then we're going to construct a multi-step income statement from scratch in the next slide. There's my original sales revenue. There's sales minus returns and allowances minus discounts gives me net sales. From net sales, I subtract cost of goods sold. That gives me gross profit. And gross profit is simply the difference between what it costs me and what I'm able to sell it for. But my gross profit has to be sufficient to cover all of my operating expenses. My operating expenses are the various expenses I incur to run my business. Operating expenses are generally speaking split between selling-related expenses and administrative expenses. Admin, or administrative, is running the office, the employees and all the costs, renting the office, the accountants, the lawyers, the receptionists, etc. Selling expenses relate to if I have stores where I'm selling goods, and my marketing and advertising-oriented expenses, commissions to salespeople, etc. So in operating expenses, we have two broad categories, selling expenses and administrative expenses. Added together, we simply call them operating expenses. So notice, gross profit minus, and in this example, we've itemized a wide variety of operating expenses. You don't have to memorize those. Just simply remember selling expense and admin expense, two broad categories. So gross profit minus my operating expenses gives me what we call operating income, also called income from operations. Okay? This is our main business. From sales to operating income, this is why we exist as a company. This is our primary business. We sell our products, and all businesses have operating expenses. So income from operations is a key figure for any business because this is their main or primary business, their central operations. Below income from operations, we still have to account for other activity, which is normal business activity, but it doesn't happen as frequently. For example, I may have some excess cash that I keep in an interest-bearing account as a business, and therefore I would earn interest revenue or interest income. Well, I have to account for it. It is a form of revenue, but it's not my primary business unless I'm a bank. But if I'm a retail business, I earn some interest revenue, and I account for it below operating income or income from operations. Okay? Notice in this example, I sold an old vehicle or an old piece of equipment, and I made a few bucks. I had what's called a gain on sale of equipment. Not my primary business, but hey, if I made a little few bucks, I have to account for it. So I put it below operating income. Okay? Give you an example. Boeing. Boeing makes airplanes. When they sell airplanes, that's revenue. That's sales, because that's what they do. But Boeing owns a lot of vehicles, pickup trucks and cars, and so every year they may sell a couple of hundred old vehicles, and they may make a few bucks. That would be gain on sale of equipment, because it's not their primary business. Boeing's not a used car dealership. They sell airplanes. But it just so happens they sell cars every year, and they turn them over, and they replace them. Now, Ford Motor Company, they make and sell cars. So when they sell cars, they call that sales revenue. But Ford Motor Company happens to own a couple of corporate jets. And maybe every 5 to 10 years they may sell a jet, and they may make money or they may lose money. But Ford is not in the airplane business, so if they make a few bucks or they lose a few bucks on the sale of a used airplane, it goes in the other revenue or other expense category. Okay? So from sales to operating income, this is our main business. Below operating income, They call it incidental or peripheral activity. We still account for it, but we know it's not as important to the ongoing success of the business. We're still reporting it, but by putting it below operating income, it tells the person looking at the financial statements, okay, it's there, but it's not as critical to the success of the business. Okay, so in our example, we have some interest revenue. We had a gain on sale of equipment, and we put that in the other revenue and gains section. Other expenses and losses, well, we have some interest expense. We borrowed some money. Maybe we had a loss on sale of equipment. Here we have a casualty loss from vandalism. Okay, so we have other expenses, and that gives us income before income taxes, sometimes called taxable income. That number, taxable income or income before income tax, we multiply that times whatever our tax rate is to determine our tax expense. We subtract tax expense, that goes to the government, okay, from taxable income, and that leaves us net income, the bottom line. That's what's left for us after we've paid our taxes. Okay, so this is the multi-step format. Let's go ahead. Before we go to our example of the multi-step income statement, we have a couple of ratios we want to talk about. This helps us to analyze our business. We have the gross profit margin, and we have the net profit margin, simply called the profit margin. Okay? And our ratio, our formula, gross profit numerator divided by net sales. Let's go back to the previous slide. There we go. Okay, so the gross profit ratio, also called the gross profit margin, or even just the gross margin, is gross profit. In our example here, it's $144,000 divided by net sales of $460,000. And if you plug that number into your calculator, it'll give you whatever that percentage may be. I don't know what it is offhand. I'm going to guess somewhere in the 30% range. Okay? And that says for each dollar of sales, we generate a 30% gross profit. That's the amount in excess of our cost, but we need that gross profit to cover all of our other operating expenses. My profit margin, or net profit margin, and by the way, in accounting, as you've probably seen by this point, there's more than one way to say a lot of things. So net income can also be called net profit or net earnings. Net income is the most common term, but rather than calling it the net income margin, they call it the profit margin. Okay, and so that's net income divided by net sales. So here, $21,500 divided by $460,000 gives you whatever it gives you. I don't know what it is offhand. I should have my calculator here. Okay, and what that tells us is that for each dollar of sales, this is how much goes in our pocket after we've paid taxes. Net usually means after, so net profit or net income after tax. Okay, now anytime you look at a ratio, you want to compare it to last year, the year before, maybe compare it to our competitors. So Ford would look at General Motors and Chrysler. If I'm Hewlett-Packard, I would look at Dell or perhaps Apple Computer. If I'm Kellogg's Cereal, I'd look at Quaker Oats or General Mills. So you compare it to other companies in your industry to see how you're doing compared to your primary competition. Okay, so ratios are useful by themselves, but they're more useful when you compare it to other companies and to your own performance from previous time periods. Okay, so you should know the gross profit margin and the profit or net profit margin. Okay, and there they are. Okay, gross profit divided by net sales and net income divided by net sales. Two different ways to analyze our profitability. Okay, now I'd like to prepare a multi-step income statement. And I'm going to do it here on the whiteboard. All financial statements, and let's review. We have an income statement, we have a statement of retained earnings, which, by the way, is really part of another financial statement called the statement of stockholders' equity, but that's okay, don't worry about that. Then we have the balance sheet, and then we have the statement of cash flows. So we're going to prepare a multi-step income statement. All financial statements start with what's called a heading. So ABC Company, that's the name of the company. Income statement for December 31st, 2000 XX, whatever the year. We call this the heading or the header. All financial statements have to have a header. Okay, let's prepare a multi-step income statement, since you may have to do this on an exam and you want to understand how to prepare such a financial statement. We start with sales. Sales is $400,000. From this, I'm going to subtract my sales discounts. And sales discounts was $10,000. And I'm going to put parentheses or brackets around that. That tells me I have to subtract that number. And I'm going to subtract sales, returns, and allowances. I'm going to abbreviate or I'll run out of room. And that's $15,000. And that's going to give me net sales. And that would be, what, $375,000. Okay? This is my original or gross sales. My customers took advantage of discounts by paying us early. So that reduced how much we actually received. And they returned some items. So my net sales, my true sales, is really $375,000. From net sales, I would subtract cost of goods sold, frequently abbreviated just CGS, and that is $100,000. So I got a pretty nice gross profit margin here, and this gives me gross profit. Okay? Now, you don't have to put lines underneath them, and in fact, you don't even have to put brackets, but I think it's a good idea so you can identify what's going on. All right? And my gross profit is $275,000. I could figure out my gross profit margin by simply taking $275,000 divided by $375,000. Gross profit divided by net sales. Okay, from gross profit, I'm going to subtract my operating expenses, selling expense and admin expense. My selling expense, or expenses, are $50,000. My administrative expenses, I'm just going to abbreviate, admin expense, are $25,000. And this is going to give me operating income, also called income from operations. Okay, and that would be $200,000. This is my primary business, the most important part of my income statement. This is my central operations. But I had some other activity. Okay, if you've ever been inside Walmart or Target, you might have seen a McDonald's, you might have seen a Wells Fargo or a Chase Bank. Okay, they sublet, they rent that out to those stores, and they generate rental revenue. So in this case, I sublet part of my building to another company, and I have some rent revenue. So I'm going to add that. Rental revenue, $8,000. And I borrowed some money, and I had to pay interest on it. I had a note payable, and I had to pay the bank interest. So I'm going to subtract interest expense of $18,000. Okay, and that's going to give me $190,000. I'm running a little bit out of space here on the bottom. Okay, and this I call taxable income or income before income tax. In our example, our income tax rate, whether it's the federal rate or the combined federal and state rate, doesn't really matter. Okay, our income tax rate is 30%, so I'm going to multiply 190, my taxable income, times 30%, and that gives me $57,000 income tax. I'm going to call this tax expense, and that's going to provide me with net income, and that looks like $133,000. And I'm going to double underscore. Okay, so we subtract our income tax expense from taxable income, And that leaves us with net income, the bottom line. Okay? So we have net income of $133,000. And if I wanted to determine my profit margin, I would take net income of $133, divide it by net sales of $375, and that would give me whatever it gives me. And I would compare that to last year, the year before, compare it to my competition, etc. So here is a full-blown multi-step income statement, which you should get familiar with. Okay, this is an important area. In financial accounting, it's important that when the class is over, since most people who take financial accounting are business majors, not necessarily accounting majors, they want to understand how to construct and interpret financial statement information. So your ability to create an income statement and to understand what the numbers represent are very important. So please take the time to practice preparing a multi-step income statement and being able to calculate both the gross profit margin ratio and the net profit, or just profit margin ratio, and try to figure out what it's telling you. Okay. That's it.